What's going on, guys? So today is going to be an educational video on how I made 150% return swing trading in only 4 days. In this video, I'm going to explain to you guys my very easy and simple mechanical swing trading strategy that has given me an edge using probabilities, and how powerful this type of strategy can become when combined with the power of options. I'm also going to explain to you guys how I'm able to use probabilities to pinpoint specific bottoms for a reversion to the means. There's only two ways you can profit from the markets: trend following or mean reversion. In this video, we're going to focus on my short-term mean reversion strategy. So the example for this video is going to be the recent trade I took buying the lows on Google. Like I mentioned, in about 4 days of swing trading option contracts on Google, I was able to net 150% return, and I'm going to show you exactly step by step how I did that using my short-term mechanical trading strategy. So right here, guys, you can see that I got filled the 15th of August and I paid only 67 cents per contract, and I was able to resell the same contract a couple of days later for $1.68. By the way, guys, this indicator right here that shows me the projections of the probabilities is not finished yet. I'm still waiting for my coder to come back from vacation. It should be ready in the next coming months, but once it's completed, I will give you guys access to my private script on TradingView. If this way of swing trading is interesting to you, hit the subscribe button and I will update you guys in the near future. So now going back to Google, let's start with the number one step. Obviously, finding a swing trade. So first we need to look at the market structure of the probabilities. Keeping this simple, if your goal is to swing trade to the upside, you are going to want to see the market structure of the probabilities in a strong uptrend. Never forget that when you're swing trading, the trend is your friend. Obviously, we can see that the market structure is in a beautiful uptrend for Google. That's how I knew that Google was a good dip buy opportunity for me to swing on the long side, with the first take profit level of my strategy always being the mean reversion of the price action, which is the green line in the middle. Keeping this simple, the market structure needs to be aligned with the direction you're betting on. If not, you're obviously going to lose money. Number two, looking at where we stand in the probabilities of the price action. When I entered, obviously we were in the lower level of the probability of distribution. More specifically, we were at the second standard deviation. And every time we're at these lower ranges, we know that based on probability, it's inevitable to have a reversion to the means. So as you guys can see, it's all systematic. There's no emotion. I just use the deviation levels and trade according to the probabilities attached to them. That's how I make my decisions. I don't draw squiggly lines on my chart. I'm not guessing using my intuition. It's all a set of rules, all step by step, based on actual real-time probabilities. It's that easy. So if we know we're going to have a reversion to the means, the next step is going to be figuring out if the trade is worth taking. What I mean by that is figuring out how much you can make from a trade. This is why my rule-based system works so well. You don't need to guess a level where the price might go. You already know that it's minimum going to go to the means. That's always going to be your target. That's your worst case scenario as the potential reward. Now I'm going to give you my personal rule of thumb. For me to take this trade, I need to have a minimum of 10% between the lower levels I'm entering in and my first price target, which is going to be the means. For now, I need to do it manually. So hopefully the new version of my script will take care of that. So if we measure from the second standard deviation, which is always my minimum entry, to the means, we can see that it does pass the test. There's 11.4% difference between where the price action is and the reversion of the means. So if you have a swing trade with an upside of 10%, now imagine how much money you can make with option contracts. All right, so personally, when we have this type of aggressive pullback in the markets, I like to wait for a retest of the second standard deviation. So right here, we hit the second standard deviation, but then this is when I entered the trade, when we retested that same level. And if I zoom in, guys, you're going to start seeing how every time we keep bouncing in between these lines, and those are actually the same ranges that algorithms use to trade the price action. That's why it works so well. So as you guys can see, once we bounce on the second standard deviation level, where did we go? We went right to the first standard deviation above, which was the next resistance. So you can see how easy it gets once you have a specific trading tool like this that actually shows you the specific level where the price action will be drawn towards. So as you guys can see right here, we kind of keep zigzagging in these zones until, we enter another zone, right? And that's how price action is formed. So right now we're still stuck in this zone right here as the key resistance support area. All right, now I'm going to show you the other rules of this system using option contracts for short-term swing trades. So now that we have identified that this trade is worth taking when we were here, we know that this trade is worth playing with option contracts, obviously, because 10% move in option contracts is a lot of money, guys. Like, you can literally make thousands with just one trade. That's why it's worth playing with options. And the beauty of it is you don't need to play with big size. You can play with a couple of $100 and make a couple of thousand every month. Now the next step is going to go into the option chain and find some cheap contracts that we can possibly arbitrage by betting against the odds that is reflected in the marketplace. Obviously, I'm not going to go through this part for this video. It's completely out of the scope. If this interests you, I will share more of my knowledge on the subject matter in the future once my private scripts are ready to be shared with people interested in learning more about my personal strategies. So for now, let's just say that while I was scrolling the option chain, I saw that the 2-week out contracts were very cheap. And so usually, because this is the short-term swing strategy, I will mostly go with 2 weeks because the payout is going to be very juicy when you end up being right, because the contracts basically have a shorter period of time. But then when you're right and the price goes up a couple of percentage, well, the value of those option explodes basically. That's how I was able to buy them for 68 cents per contracts and then resell them for $1.68. And so basically, after you basically followed all the step and you buy the contracts, there's not much to do but to let the price action revert towards the means. So now I'm going to go a little bit more in detail. So when the time frame is shorter, like this specific trade, instead of selecting a strike price of the means, which is about 180, I will select the next upper level of the deviation as my strike price, which is right here, $170. So remember that I entered in this range right here on the second standard deviation, and the strike price I'm going to select, even though, yes, we could go to the means. Obviously, right now we're being rejected. But like I showed you guys, you're better off going with the strike price of the level above, which is 170. And that's how I was able to be so accurate and make so much returns in a very short period of time by being very selective of the strike price and the time horizon, and knowing that, okay, well, the broad market is about to reverse. We're going to have minimum a reversal to the means for the S&P 500. Google looks really good for reversal, so I'm going to enter right here. And my target, because the option contracts only have a 2-week expiry, is going to be the next level. It's that easy, guys. And again, as you guys can see, I'm not using my intuition or my personal opinion to select the strike price or the levels where the price action will go. It's all systematic. And like I mentioned, the reason why I was able to make this much returns in such a short period of time is because of the accuracy of the 170 strike price. And then where did we go? We went to about 170 and 34 cents before getting rejected. So yeah, that's pretty much how I was able to buy a contract for 68 cents and resell it for $1.68, if I recall, in only 4 days. So hopefully this helps, and you can really see how powerful having a rule-based system is and how easy it is once you have a step-by-step guide. And the best part is that my TradingView tool calculates the levels for me. So nothing is relied on my intuition or me having some sort of Jedi mind superpower. I know for a fact that learning this strategy will make anyone a profitable trader on the swing trading side. If you're interested in learning these type of mechanical strategies directly from me, without wasting your time backtesting and using your emotions trying to figure out by yourself a successful swing trading strategy, you can just subscribe and in the next coming months, I will start teaching these to a very small group of people. So stay tuned for the next announcements. Alright guys, that's it. Hopefully you learned. Hopefully this was a cool educational video and it really kind of gave you a better understanding how to properly trade with an edge. Have a good one. Stay blessed. See you in the next video.